Okay, we wanted to start off by quickly doing a recap of what our views have been so far this year. I think anyone who has joined us in our previous webinar that Dharma and I hosted, that you probably have already heard this, but just to sort of recap the way we see things right now. So if you recall at the beginning of the year, we thought this was a pretty clear period for investing where we would see a strong rebound supported by the vaccinations. And this would allow growth rates of GDP and the growth rate of earnings around the world to be among the highest levels we've seen in the past 20 years. And at the same time, this would be an environment where short rates would be kept very low for a considerable period of time. And that this combination of strong growth and low rates really is one that adds up to a healthy environment for investment markets, and in particular for growth assets like equities and even commodities and other growth assets. And so far, I think that is largely what's played out. I don't think it was a very unique view. I think in this cycle, more so than I recall in other cycles, almost everyone seemed to be on the same page. When I would talk to clients, everyone believed this was a good time to invest. And you see that in the fund flow data around the world. You see lots of retail participation. You see lots of the funds around the world growing. You see the ETFs seeing lots of positive fund flows. And that has driven markets for the first half of the year. As we update things now, we would say that those views largely were borne out, but there are some sort of question marks along the way. We would note that on some of the questionable things we're seeing is that, one, while the vaccines and the rollout has gone very well in many parts of the world, there are still large parts of the world, and in particular us here in Asia, that have seen a slower pace of the vaccine rollout. I'd say on top of that, we've seen the fact that short-term rates have been kept low. But another issue that has sort of been creeping up is that inflation has been higher than expected, and that's caused longer-term bond yields to go up. So for the most part, I think we would recap the first half of 2021 as largely being on track, but there's increasing question marks that have been coming up. And so when it comes to our allocations right now, we in the past have usually shown a table we use to indicate which sectors were overweight and underweight. And some of our key views now is that we still believe that we're in a period of healthy expansion. But in the near term, we do think the market is likely to go through some process of what we call transition. And we'll discuss that more in our conversation today. But because we're sort of gone through the strong year of peak growth, now growth will sort of moderate to more normal expansion levels. And that doesn't have to be bad for markets. But in the transition period, we think these are periods where markets can be a little unstable in the short term. So for the near term, we're a little bit more neutral and cautious on risk assets. But on a medium to long-term basis, we're still quite constructive. And you can kind of see that in our positioning, where we're a little bit more neutral on equities for the moment, and a little bit more neutral geographically. But really many areas such as high yield, such as commodities, such as alternatives, we still are maintaining overweight positions. So that's a quick recap of where we think we are now. Now, how about let me invite Dharma to jump in and just give a little bit of a recap on what we think on a cyclical basis. And this is kind of more of our sort of medium to long-term thinking. So Dharma, could I ask you to cover our investment clock?
Sure. Thanks, Tony. Yeah. As you know, basically in UOB Asset Management, how we look at the investment cycle and economic cycle is through the lens of this investment clock. So basically, there are the sort of various stages of the economic cycle: recovery, boom, slowdown, and recession. And at each stage of the cycle, we basically would invest in different asset classes. Right. So basically, in the sharp recession of 2020, the investment clock was reset. We believe that we are now at the beginning of a recovery. I think based on what we see throughout history, the economic cycle usually lasts more than 5 years. In fact, the average cycle typically would last somewhere between 8 to 10 years. So we've just come out of that economic recession caused by the COVID in 2020. And albeit that was a very short recession, a very short and sharp recession, we think that the cycle would have quite a few years to come. We are only in the second year of this recovery. So we think that the recovery would still have legs, and therefore we should still be invested invested in sort of the growth assets and the risk assets, and it will take a few years before this economic cycle plays out. Back to you, Tony.
Okay. So in this next part of our conversation, we wanted to keep this in a format of a fireside chat. The fact is, we think there are a lot of interesting things going on in the markets, and in our own strategy committees, we're having a lot of these conversations. So we wanted to share with our clients what we're discussing internally, some of the thoughts that are on our mind as we're seeing some interesting developments in markets. So I'd say, as we discuss this, some of the key topics have to deal with this issue of transition that I mentioned. So historically, after the first year of recovery, the first year sees the strongest levels of growth. That's when you're recovering from a very low base, and the growth rates, for example, in 2021 are really very high. So for example, global GDP in 2021 is expected to be around 6%, and we really haven't seen that in decades. And yet, even though the expansion continues, as we look through to 2022, we will expect growth to moderate back to more normal levels. And then additionally, at the same time, other issues that happen in the second year of a recovery is that you're starting to see policy normalize. You'll start to see that the fiscal initiatives around the world start to normalize. You start to see the central banks around the world start to pull back some of their ultra accommodative policies. And markets can persevere through this, but it usually becomes a little bit more dicey along the way. It becomes a little bit more choppy. And so we wanted to talk through some of these issues and how we're thinking about these issues of transitioning into this second year of expansion. So one of the issues that we talk a lot about is this concept of peak growth and what will growth look like in 2022. So maybe I'll start there and ask you, Darmo, can you summarize some of your thoughts on how you think this slowing but continued growth implies for the market?
Yeah, thanks. Yeah, I guess as you pointed out, I mean, last year we had a very strong growth because of that sharp recession. The recovery was equally sharp and partially helped by very easy monetary policy, helped by a lot of fiscal stimulus. Government around the world were spending almost 20% of their GDP in terms of supporting income, supporting businesses. And this year, we will start seeing sort of tapering of that, or even some withdrawal of some of those stimulus, especially on the fiscal side, on the fiscal support. So this year, the growth would probably slow down. As you mentioned, it's probably slowing down to 6%. It's still above trend growth, but coming off from a 20% growth, 6% growth, can feel like it's a sharp slowdown. And I think that's probably sort of the change in momentum or the change in velocity that people tends to feel the hardest. And I think that gives people pause in the sense of reassessing how they think about the economy and how they think about market. I mean, obviously, you can feel it too. The government support in terms of job support, wage support, or even support on businesses is gradually being withdrawn, and sometimes we feel that directly as well. So with that, there's always people have a bit of uncertainty in terms of where the economic momentum would settle down to, because whether that 6% is achievable, or would Will we even slow down much more? Those sort of questions tend to come into people's mind, and therefore market would be a little unsure and becomes a little more uncertain and therefore a little bit more volatile in terms of how to price that slowdown. And I think that's what we're seeing, and in fact, that's what we tend to see in the second year of recovery, and that's what we are seeing today as well. What do you think, Tony? What are your thoughts?
Yeah, and to put like just some fine numbers on it, I would say that if we looked at Bloomberg consensus numbers, so for both earnings and GDP, let me just give the key numbers that I sort of keep in the back of my mind. So for 2021, global GDP is expected to be 6%, and in 2022, it's expected to be 4.4%. And for everyone's perspective, I usually use the rule of thumb that anything above 3.5% is a strong year of growth. So for example, 2017, 2018 were strong growth years, whereas 15 and 16 were low. So 15 and 16 were about 3%, and then 2017 and 18 were a little bit above 3.5. So at 4.4, it's still a good year of growth in 2022. But I think like your point is right, Darmo, that when we're seeing slower numbers, we don't know where the bottom's going to be. We just see it trending down. And likewise for policy, as the central banks start to taper a little bit on the amount of accommodative policies and bond buying they're doing, I think most economists think, yeah, that should be okay. There looks like there's enough momentum in the economy, but there's a little bit of anxiety in markets that, well, if the Fed pulls it away a little bit, are we sure the momentum's there to continue this forward? And I think that's where jitteriness in the markets come from. And so, like, for example, we cite the example of 2010. So if you recall, there was the very sharp recession in 2008. 2009 was a recovery year, a very strong one, very similar to this one. Markets had a great year. But then in the second year, in 2010, the expansion continued and markets ended up. But in the middle of that, there was a bit of a wobble in 2010 where markets declined about 10% before they sort of stabilized, got reassured that the expansion's continuing, and then went on to make new highs. So I don't even think that's necessarily our forecast, but I just think we need to be aware that that's the way sort of these transition periods usually go in an expansion cycle, and we should just be a little bit careful in timing all of our purchases. So just to continue that issue, this issue of the way policy transitions, how about, Dharma, let me ask you, so what are you expecting, both in terms of fiscal policy and central bank policy around the world?
Okay. I think on the fiscal policy side, definitely what we are seeing is whether you can call it a fiscal cliff, meaning that there were a lot of fiscal stimulus that was injected last year, and this year, even if governments continue to inject fiscal stimulus, the fact that if they inject less than what they did last year, there is that withdrawal of that fiscal stimulus, in the sense that there is, from a rate of change point of view, or from a second derivative point of view, we are seeing a withdrawal of that fiscal stimulus. I mean, hopefully, is of course, as economy begin to pick up with the reopening, there is less need for government to spend those money because the economy itself is making up for that. But definitely, I think there is probably a bit of jitteriness that as fiscal stimulus are being withdrawn, whether the economy is strong enough to stand on its own, or whether the economy would be able to offset that withdrawal of that fiscal stimulus. So that's actually the first point. The second point, I think, is on monetary side. The U.S. is probably thinking about tapering its quantitative easing or its bond purchasing program. But I don't think that interest rate hike is anywhere in the card for this year or even next year. So I think monetary policies would be relatively easy, but even if we talk about tapering, it becomes marginally less loose, right? So because they would be buying less bonds if that is to happen. I think it is that rate of change that market is really uncomfortable about, or market is really wary about, whether that tips the economy back into recession, or whether that basically causes problems to the economy. I think that's one of the transition that you mentioned, that market is continually staring at, and I think there's a bit of a tug of war between market participants on what is the real effect, or what is the impact of that second derivative in terms of fiscal stimulus and monetary policies. What do you think?
Yeah, and I think to put a fine point on it, it's the amount of policy support that we're still going to get over the next year is really incredible by historical terms, right? Like you mentioned, the central banks around the world really keep committed to keeping short-term rates low, and adopting new policies both in Europe and in the U.S. that are much more seeking out new levels of higher inflation to balance out all the years that we've been undershooting on inflation. These are extraordinarily accommodative policies. But as you mentioned, there is a second derivative going on. Markets will get a little jittery when you're just going from extremely high to very high levels of accommodation. And therefore, I think as we've talked about it, our view is that definitely the base case should be to believe that the expansion should continue, that growth assets should perform, that we should be leaning into performance of areas like equities. But I think the message we're highlighting it, and I think we've been seeing it in the past month or so, that these are complicated periods for markets, and you do get some jitteriness. And then I guess to add on to the fact that those are sort of just normal issues of transition, I think we've been dealing with some sort of specific issues in this cycle that have sort of popped up a little bit more so than expected. And I guess I'm firstly thinking of inflation and some sharp movements in bond yields on the back of that. So, I mean, to introduce the topic, of course, I think most of us are aware that on a global basis, especially in the developed markets like the G3 markets, inflation has been extremely benign, if not disinflationary, for the last almost 2 decades. And I think we're at the point where many economists are starting to wonder if areas like Europe and even the US are sort of turning into Japan, into the levels of disinflation or even deflation they may be seeing in the future. But right now, suddenly we're seeing much higher levels of inflation than we've seen in a long time. So let me ask you, Dharmo, what are your thoughts on these inflation prints that we're getting? So it's particularly in the U.S. Actually, the inflation numbers in Europe and Japan are still fairly benign. Some pockets of inflation, maybe in China, but even there, it's not so bad. But in particular, the U.S., we're seeing higher prints. So what are your thoughts?
Well, I think in our daily conversation that I'm actually quite worried about inflation. I mean, if I look at the recent inflation numbers, if I annualize those month-on-month number, I mean, when we compare inflation versus last year, we can always argue that it was a low base effect last year. But what I was looking at, or was watching is really the month-on-month number. And if we look at the month-on-month number and I tabulate all this month-on-month number, what I get is that if you annualize the latest month-on-month number, you get something like 10% inflation annualized. Obviously, there is some one-off in there, and I'm prepared to admit that. But even if we sort of give a discount to those one-offs, if I add the month-on-month number that we have been accumulating so far, I won't be surprised that by the end of the year, we get an inflation number that is closer towards 4 to 5%. I think my concern is that the market will get a sticker shock if that happens, meaning that by December, you get a year-on-year number that's like 5%. and people have been saying that this inflation is transitionary. It was a low base effect last year. But if by end of the year or early next year, we're still seeing 4 to 5% print, I think there's going to be a lot of debate on whether this inflation is really that transitory, right? I mean, we discussed this quite a bit, or we debated this quite a bit internally. If we look at the sort of the underlying numbers, I mean, what's driving the underlying numbers, there are quite a bit in which that it's your used cars or it's your airline tickets, all those things that are adjusting because of, whether it's because of supply shock or supply shortage from previous years, or because of the opening of the airlines industry. There's a bit of that. But I can't help but be concerned when I look at oil prices, when I look at, say, commodities prices, and it's not just, it's in copper, it's even in your agricultural commodities. All seems to point to a higher inflation number than what market is expecting. So I think that is my concern. I think ultimately it might take a couple of years for inflation to settle down back towards the 2 to 3% range that we're used to, or the 2% range that we're used to. But I think during this transitionary period, we may see inflation looking a bit sticky or a bit stubborn. And we have not even taken into account the fact that wages, there seems to be a little bit of pressure on the wage side. When we talk about businesses unable to find people, there's a bit of pressure for wage to increase. And I think that has not even been factored into the current inflation numbers. And I think my concern is that market will get a sticker shock come nearer the end of the year or even early next year.
So I would add that I think, in our strategy committee, Darmo has been one of the ones highlighting the concerns about inflation. I would say I'm a little bit more in the other camp of saying that I really think this is looking transitory. But I'd acknowledge some key points about the risk. So I think Darmo's right that a lot of where the price inflation is coming from are sort of supply chain bottleneck issues that logically you should think should go away. But looking at it, it doesn't look like it's going to go away that quickly. So in particular, when you're looking at where the inflation pressure is coming from, you are seeing it in like used cars, in car rentals, and airlines, as Darmo mentioned. And a lot of those issues, when you delve into it, it doesn't look like that's going to be solved in the next year. It's going to take probably throughout 2022 before those issues are addressed, right? I think we all know about airlines, how much the capacity has been downsized. And in places like the US now, where they are traveling, they are getting back to normal, the reality is they don't have enough pilots ready that have been trained up. They don't have the planes ready. I've had family members that went to try to do a small trip on a flight, and they said they arrived at the airport 3 hours in advance, but there was so few people available at the airport to do security and all the screening that even with 3 hours, they didn't make it their plane in time because of all the log jams. So I think there's it's going to take a lot of work to get the world back on track. And therefore, I would acknowledge Darmo's concerns that these things aren't necessarily going to go away easily. But in the end, to me, these do look like transitory issues. And I won't really be convinced there's an inflation problem until I really see it in wages. And I think that one, there are some reasons to believe wages may be going up. But in the end, wages have been suppressed for a long time. And things like trends like automation are so big that I would still be a little doubtful that wages really face continued sustained upward pressure, and that the deflationary forces of the last couple of decades still weigh on markets to a fair degree. So, and I guess in the end, I would also say that the Fed is the one who's going to decide this. And at this point, they're still convinced it's transitory, and they have a bias to even allowing some inflation to happen. So all that speaks to is as long as it doesn't get badly out of control, I still think we're in a healthy environment that's going to be conducive to investment markets.
Okay, then maybe let me ask you a question, Tony. I mean, you're bullish on growth, and you think that, but current inflation number is actually looking relatively high. We can debate on whether that's transitory or not. But why then is the 10-year bond yield so low, right? Why is the 10-year Treasury yield so low? I think that's probably a question on a lot of people's mind. Why is it that when growth looks so robust and growth is hunky-dory, 10-year yield is at 1.2%, right? I think at one stage it even fell below 1.2%. Why? What is the bond market really trying to tell us?
Yeah, I think that's a good question. And I would add, there's been a lot of oddity in the behavior of markets for the last month. The 10-year bond yield is the biggest one. That is really stunning to see that decline the way it has. And additionally, I would argue that you've seen a lot of sort of risk-off behavior in the market. You've seen the dollar go up. You see gold go up in the last month. You see oil, which was really high, start to wobble and broke below 70. So there's a lot of sort of just trends in the market that we're looking quite risk-offish. I think our views it's been a combination of three main things. It's been one that the pandemic has been getting worse, and in particular, the market is scared about what the Delta variant implies. I think secondly, the Fed has put out more hawkish comments, and that sort of caused some jitteriness that maybe the Fed is about to turn to be too hawkish. And then thirdly, China is both slowing down and implementing a lot of regulatory policies. And I think these three issues have sort of weighed on markets in the last month to create a little bit of a risk-off environment, even though it's a little bit hard to see because equities continue to make all-time highs, even as of this morning. So I'd say markets are giving mixed signals right now. And then in particular on the 10-year, I would say that ultimately our view is that we do believe that these risks will be managed, that we do believe in an expansion. And as the expansion continues, that should generally put upward pressure on like a 10-year yield as we get closer to the time where the Fed starts hiking rates, and eventually we'll get closer to what they have in their terminal rate of the Fed funds. And so we believe that's the way it should go. But at the same time, we think the Fed is going to be quite slow in that process, and therefore we don't think 10-year yields should have tremendous upward pressure. So just to put numbers on it, by the end of the year, UOB Asset Management's house view is that we think 10-year bond yields should be around 1.5 to 1.75. We think that would be a very logical level given an expansion process. At the same time, it's surprising right now that the 10-year yield has fallen to just a little bit below 1.3. So that's at the lower end of this range. Have you watched this market behavior for the last month? What have you made of it all, Dharma?
It's really puzzling. I mean, basically, the 10-year yield has survived. Since peaking in March at about 1.75, it's come down, and we basically said initially we thought that it's because market volatility. 10-year yield, 10-year Treasury is the safe haven. You can buy a bit of that, but even when there were a lot of news flow that is supposedly negative for bonds, or that basically should cause bond yield to go up, hasn't been able to move the bond yield that much. I think I mentioned we have had a few inflation prints that were higher than expected. And in fact, as I said, if I look at on a month-on-month number, it actually looks alarming. We had the Federal Reserve sounding a bit more hawkish, talking about them thinking about tapering or thinking about rate hikes. and sort of the dot plots, that means the projection of where the Fed fund rate will be has actually gone up. And yet, the 10-year Treasury yield has not moved that much, right? It's been still below 1.3, despite all this negative news. So that's why I guess I'm a bit puzzled. There are probably a couple of theories that I'm toying, and I don't know what's right. One is, of course, people believe that the growth number is not as rosy as what the consensus think. That could be one. The second one is, of course, people are thinking that Fed could make a policy mistake and probably tighten monetary policy a bit too early. That could actually cause some issues. And I think these are the two possible reasons that I could think of why bond yields are still so low. None of them basically, I think, is the base case, but I can be sympathetic that these are some of the considerations that the bond market have in terms of why they're basically buying up 10-year Treasury till such a low yield level.
I was going to add that, I mean, I think I see we have just a few minutes left in this fireside chat component before we go to Q&A. But the big sort of elephant in the room, I think, has been the pandemic. And I think we should just give our quick thoughts on that before we run out of time. And so I think you've seen it in market pricing. So not only the rally in treasuries, but also when you look at that equities have been performing well, but when you look at what type of equities have been performing well, this looks more like the type of stocks that were performing in 2020 when we were in the midst of the pandemic. So it's tech stocks, it's big cap growth, it's you see the work from home baskets. That's companies like Zoom are outperforming the reopening type companies like airlines and so forth. And so we think that the pandemic really is so increasingly a concern. You're seeing it in market pricing. And so it does boil down to this Delta variant. I think we all have been following it, but I would say I think the market takeaways on the COVID variant are that one, that the vaccines still seem to work when it comes to preventing severe disease. There does look like there are a lot of studies that are saying the vaccines are working to prevent hospitalizations and deaths and severe disease. But what it's not doing so well with the Delta variant is preventing disease outright. And therefore, it's allowing more spread. And I think maybe you've seen all this data too, but the Delta variant is nearly twice as contagious, and it's almost twice as deadly when you match up age group for age group on what their outcomes are being. And so the fact is, I think markets are anxious what this means, because in particular, when you look at the trajectory of what cases are going to look like, especially in a place like the US, I think we should buckle our seatbelts, because I think the next month is going to look bad in the US. And then by the end of the year, we may see another one of these waves, because we are going to see cases even amongst the vaccinated. And I don't know, I think markets are struggling on what to think of this. In the end, I know our strategy committee does think that in the end, if the vaccines are preventing severe disease, then they are ultimately working, then we can treat this more as a flu. And we think that, therefore, the base case assumptions on expansion continue. But, the data is worrisome, and I think it's going to feel bad for the next month. And especially, us based in Singapore, I think we're getting exactly that message, I think, from the ministers in Singapore, that we got to focus on vaccinations. We're not going to prevent all cases anymore. As long as we're preventing hospitalizations, then we continue to reopen. And I think that's where the world's going to be. And purely from an economic sense, that's okay. That allows our base case to continue if the world continues to reopen. But anyway, there's various issues in the markets, and we think this one's going to be scary for the next month.
Okay,
So I
Tony.
think we've used most of our time, Darmo.
Yeah.
I think, do you have any last comments before we go to Q&A?
No. In fact, let me start by asking the first question. I think the other elephant in the room, as I think that was asked by quite a number of people in our audience, China, right? I think that's very close at heart. What we've seen, as you mentioned, was that U.S. market, and in fact global market, has been making new all-time high. But in Asia, I think in Asia things have sort of slowed down, or market have slowed down, and a big part of it is because of the sell-off in China, and there seems to be a lot of recent events within China, a lot of government action. What do we make sense of all that? Okay, we have a bit of technical issue. Tony is out, so maybe I'll start by giving my 2 cents worth. I think there's quite a bit that is happening within China, but I think there are a few guiding principles that we are seeing. The Chinese government is not just concerned, it's probably comfortable enough about economic growth after coming out of COVID last year, and being the first country to come out of COVID, and having a year in which that they didn't suffer any recession. They are probably comfortable enough in terms of the growth rate that they are more concerned about the social aspect, or the social justice aspect of the country, right? So in the past, it used to be they are more tolerant of tech companies, and they basically try to regulate with a very light touch. But as they start seeing more and more in which that tech companies are becoming monopolies, and they are using that monopoly power to gain for their own good at the detriment of the country, I think there is probably a little less tolerant for that, right? So that's why we see action against Ant Financials, we see action against the platforms, whether your private car hires platforms, or your food delivery platforms, that is seen to basically exploit the gig workers, to exploit the drivers and the delivery riders. Those are actions in which that the government are now less tolerant of and try to address. And recently, I think obviously the most recent one was targeting the education companies. I think there's a bit of concern in which that the education companies are exploiting anxieties about parents' anxiety about kids' education, and there's too much pressure now on children, and of course, education companies, or this sort of after-school education, tend to favor the well-to-do, in a sense that families that can afford to send their kids for tuitions at the expense of kids of the poor families. So I think there's a bit of all this social justice issue that the government is trying to address, and they basically said economic growth is probably comfortable enough that we can start tweaking some of this imbalances or social imbalances in these industries. I think that's probably some of what's happening. So basically, if I look at it, the sort of guiding principle is that if there is too much monopoly power, and the government is seeing that companies are using monopoly power at the detriment of consumers, or at the detriment of smaller competitors, I think that's probably going to be targeted. And then if there's social justice issue in the sense that government is seeing that companies are doing things that doesn't meet the that is not in line with their social policy objective, I think those companies would likely be targeted. Tony, you're back. Any thoughts on China?
Yeah, and I see. I'm looking through the questions. I see there's a lot on China. Some of them, like mentioned, will simply China and U.S. ties improve. I see. Yeah, just generally questions about how much of this is going to continue to weigh on markets. So I'd say some quick takeaways is one. If you've heard me talk before, I've been really thinking that this is going to be a good year for Asia. And for the most part, I think so many things are aligned for this to be good. But these China regulatory issues really have been weighing down markets quite aggressively. I think in the end, we continue to believe that a lot of this can be sort of short-term negative, medium to long-term positive, that in many ways regulatory controls to make sure that excesses are controlled can be good for markets on a medium to long-term basis. But I think there's no doubt that in the near term, investors really don't know what is going to be hit next and how severely, and that creates just too much uncertainty in the near term. So I think ultimately, I would still stick to my guns that I think there's going to be an investment opportunity sometime in the second half of this year. But I think we have to play it really cautiously right now. There's the levels of uncertainty are high.
Let me continue with that. I think we think that in the medium to long term, basically Asia still represents good investment opportunities, but in the short term, definitely is something that we will be cautious. We'll be cautious on, and our view is that we probably lean more towards the U.S. and even Europe in terms of investment opportunities in the short term. And I think basically our view, or my view, is that a lot of times the COVID actually doesn't affect markets. I mean, what we've seen was that last year when COVID was still raging, that didn't stop, say, the U.S. market from rallying. And this year, when COVID was at its worst in India and Brazil, those markets were rallying. I mean, those markets were continuing to do well. So COVID doesn't really impact markets. It's really the lockdown that affect markets. It's more like the lockdown that Southeast Asia and even Asia impose on the country and impose on businesses that tends to impact the market. And I think that's basically the general rule. So I think that as the economies open up with the vaccination level going up and economies start to open up, I think market starts performing. I think using that as a guide, I think the region that I'm personally more bullish on is really Europe, in which that we are starting to see the opening up of the economy as vaccination level goes up. And I think that probably means that economic activity starts picking up. And I think for Asia, it could be, I mean, we are now probably in the midst of that vaccination, but we are probably still lagging behind on the vaccination rate. So if we continue on that trajectory, I think Asia probably starts performing about six months down the road. I think that's for me is sort of the rule of thumb that I use in terms of where I'll put my money. Okay, let me see if there's any more questions. Let's see if there's any more burning questions. what are the tech trends, and how do we look at that? I think in terms of the tech trends, it's definitely something that we are bullish structurally on. To us, we think that these are structural growth areas. So basically, whether we're talking about AI, the potential for blockchain, automation, clean energy, genomics, these are all areas in which that would be positive in the longer term. There's definitely a lot of potential in all this technology, and it's exciting because in the last few years, what we've seen most is really the application of some of technology on I guess on consumption. For example, you get platform companies, you get e-commerce companies, which have actually been e-commerce companies have been around since 2000, but we are still excited about it even up to today, right? So what we have not seen is really in breakthrough in terms of the basic technology, and I think next few years there's probably a lot of these opportunities in which we see breakthrough in the basic technology. So we are definitely positive in this area, and we think that it should be part of one's investment portfolio. However, saying that, I'm also mindful that we can overpay for some of this stuff. I think that the example I'll give is that if you bought NASDAQ at its peak in year 2000, you actually don't break even until probably 10 years later. So it takes about a decade for you to break even if you had bought NASDAQ at its peak. So there could be valuation is something that we should be mindful of, and you should be mindful of. So it is something that you should consider when you invest in this sort of technology. Okay, great. I think we've come to the end of the session. So thank you very much for attending. If you have any further questions, don't worry. Our colleagues will basically be tabulating those questions, and we'll try to answer you offline where possible. In the meantime, stay safe and stay united, right? I'll see you again next time. Bye-bye.